Hey everyone, and welcome back to the channel. Today, we're diving into a topic that might sound a bit complex, but it's super important if you're investing internationally. We're talking about currency hedging. You might be wondering, what on earth is that? And why should I care? Well, if you own any stocks or assets in another country, you're not just betting on the company. You're also exposed to the ups and downs of its currency. Stick around, because by the end of this video, you'll understand exactly how currency fluctuations can impact your returns and what you can do about it. So, let's start with a simple scenario. Imagine you're in the United States and you decide to invest in a fantastic Japanese company. Let's say you buy shares worth 1 million Japanese yen. At the time of your investment, the exchange rate is 100 yen to $1. This means your investment is worth $10,000. Simple enough, right? Now, let's fast forward 1 year. The Japanese company you invested in did great. Your shares are now worth 1,100,000 yen, a tidy 10% gain. You're feeling pretty good about your investment skills. But wait, there's a catch. Over that same year, the currency exchange rate has also changed. Let's say the US dollar got stronger, and now $1 buys 110 yen. So, what happens when you convert your investment back into US dollars? Your 1,100,000 yen. When divided by the new exchange rate of 110 yen per dollar, gives you exactly 10,000 US dollars. That's right. Even though your stock grew by 10% in its local currency, your return in US dollars is zero. The currency movement completely wiped out your investment gains. This is what we call currency risk, and it can be a silent portfolio killer if you're not paying attention. Of course, this can work in your favor too. If the US dollar had weakened against the yen, your returns would have been even higher. But as investors, we generally want to make money from our investment choices, not from unpredictable currency swings. Relying on favorable currency movements is more like gambling than investing, and that's where currency hedging comes into play. In a nutshell, currency hedging is a strategy used to protect your investments from the negative effects of exchange rate fluctuations. Think of it like buying insurance for your international portfolio. You essentially locking in an exchange rate to minimize the risk of losing money due to currency movements. The goal isn't to make money from the hedge itself, but to neutralize the currency risk so that your investment's performance is based purely on the asset's performance, like that Japanese stock we talked about. So, how do you actually hedge your currency exposure? For most individual investors, the most accessible way is through currency-hedged ETFs or exchange-traded funds. These are funds specifically designed to track an international index while simultaneously minimizing the impact of currency fluctuations. Let's look at an example. You might find an ETF that tracks the MSCI EAFE index, which covers developed markets outside of the US and Canada. There will be a standard version of this ETF, and then there might be a hedged version. The hedged version uses financial instruments called currency forward contracts to offset the currency risk. Here's how it works behind the scenes. The fund manager essentially enters into an agreement to exchange a certain amount of foreign currency for US dollars at a predetermined rate on a future date. This locks in the exchange rate, so it doesn't matter if the foreign currency strengthens or weakens against the dollar. The Fund's return will much more closely mirror the return of the underlying stocks in their local currency. This sounds amazing, right? A way to get international diversification without the currency headache. And for the most part, it is. If you're investing in developed markets like Europe or Japan, where currencies can be volatile against the dollar, a hedged ETF can provide a much smoother ride. It helps you focus on the fundamentals of the companies you're investing in, rather than worrying about central bank policies or geopolitical events that can send currencies on a roller coaster. However, like any investment strategy, hedging isn't a free lunch. There are some important downsides and costs to consider. First, hedging isn't free. The fund managers who are executing these hedging strategies charge a fee for their services. This usually means that currency-hedged ETFs have slightly higher expense ratios than their unhedged counterparts. It might only be a small difference, say 0.05%, but over the long term, these costs can add up and eat into your returns. Second, by hedging, you're giving up the potential upside from favorable currency movements. Remember our example where the dollar weakened. If you were hedged, you would have missed out on those extra gains. You're trading potential extra profit for stability and predictability. For many long-term investors, this is a trade-off they're willing to make, but it's important to be aware of it. Another point to consider is what's called the cost of carry. The forward contracts used for hedging are priced based on the interest rate differences between the two currencies. If US interest rates are higher than, say, Japanese interest rates, there can be a positive carry, meaning the hedge can actually contribute a small positive return. But if US rates are lower, the hedge will have a cost, which can be another drag on your performance. This can get a bit technical, but the key takeaway is that the cost of hedging isn't fixed. It changes based on global interest rate environments. So, the big question is, should you hedge or not? The answer, as with most things in investing, is it depends. It depends on your investment horizon, your risk tolerance, and your view on the currency markets. If you are a short-term investor or a retiree who is drawing income from your portfolio, currency volatility can be a major problem. A sudden, sharp move in exchange rates could significantly impact the value of your portfolio just when you need the money. In this case, hedging can provide valuable peace of mind and stability. It makes your returns more predictable, which is crucial when you're relying on that money. On the other hand, if you're a young investor with a multi-decade time horizon, the argument for not hedging is stronger. Over very long periods, say 20 or 30 years, currency fluctuations tend to even out. The highs and lows often cancel each other out. Some studies show that over these long time frames, the returns of hedged and unhedged portfolios tend to converge, and the extra costs of hedging can mean the unhedged portfolio actually comes out ahead. For these investors, accepting the short-term volatility of currencies might be a reasonable price to pay to avoid the long-term drag of hedging costs. There's also a middle ground approach. Some investors choose to hedge only a portion of their international holdings, say 50%. This gives them some protection against currency risk while still allowing for some potential upside from favorable currency movements. It's a way of diversifying your currency strategy itself. Ultimately, the decision to hedge is a personal one. There's no single right answer for everyone. The best thing you can do is understand the trade-offs. Understand that by not hedging, you are taking on currency risk. By hedging, you are paying a cost to mitigate that risk, and you're also giving up potential gains. My advice is to review your international holdings. Look at the funds you own. Are they hedged or unhedged? Do you even know? Many investors don't. Once you know what you have, you can make an informed decision based on your own financial goals and time horizon. Don't let the complexity of the topic scare you. At its core, it's a simple question. Do you want to take on currency risk, or do you want to pay to avoid it? I hope this has cleared up the world of currency hedging for you. It's a key concept for any global investor. If you found this video helpful, please give it a thumbs up and consider subscribing for more content that helps you become a smarter investor. Drop your questions and comments below. I'd love to hear whether you hedge your portfolio and why. Thanks for watching, and I'll see you in the next video.